Equity prices, just to keep in mind, many times in inflation adjusted, therefore purchasing power terms, have declined 60 or 70%. From 1966 until 1984, you had a negative real return. Most importantly is price. I think a lot of investors make the mistake of thinking, I want to buy good things. You know, that's a great company. But a great company that gets expensive is much worse than a bad company that's really cheap. So you have to look at pricing. This is all part of the cycle. You know, everybody says that's great and it's going to be great for the future. And like the internet and .com, it's great, okay, but the price has to be paid attention to. And I'm particularly concerned of those companies at a time when we are in a situation with the interest rates operating as we are. In other words, this looks quite like 1998 or 99, where the assets of the new hot thing are hot, the prices are high, and you have a rising interest rate environment. That is a classic issue. So we have to pay attention to the interest rates and the pricing of those assets, and you have to think where is next. Credit is like blood that brings nutrients to all of the parts of the body, and it passes through a system that is like arteries, and then credit creates debt. And the key question, if it's healthy, is does the debt create an income that is more than enough to service the debt? And that's like, I don't know, eating vegetables or something. It's a healthy process. And if not, credit begins to build up this debt. It begins to become like plaque in the arteries. And you can measure it, just like you could measure it in the arteries. And you can see how it constricts that circulatory system, because as credit and debt service rise, you see that it eats up more and more consumption because you have to spend that. So you could watch the government do that. You can see that how interest is eating up and debt service is eating up, and that means there's less money. And then you also can see how heart attacks take place. And they're very, economic debt heart attacks. And the way they take place is by looking at the supply and the demand. If you have a lot of debt, and then you have a large supply of debt, that has to be bought. Somebody's got to buy it. And so when you get to the point where there's debt risks, there's not only the new supply that has to be offered, but there is the possibility of holders of those debt assets selling those debt assets. And so the supply becomes overwhelming relative to the demand. And then it's the same dynamic for the government as it is for an individual or a company, except the government can print money. So when that debt service burden rise, or there's a big supply-demand imbalance, if the government, most importantly the central bank, doesn't print money and buy it, then there has to be a rise in the price of the debt to constrict borrowing, and that borrowing constricted, that credit that is not going to come, will weaken the economy and cause bad economic conditions. And so they can let that happen, or they can print money and buy the debt and monetize it. When they do that, that's inflationary, and it lowers the value of the debt. In either case, you don't want to hold that debt, because either there's a debt service problem or there's a depreciation. You get paid back with a greater supply and cheaper money. And that is the dynamics, and that's the mechanism. And because it can be measured, it can be seen in all countries, you can watch it happen. And so like you're going to your doctor, you can measure these things, you can see them, and you can know what needs to be done. There were two waves. The first wave was the COVID wave, in which they put out, the government wanted to, and actually did, deliver a lot more money to people, companies, then there was a loss of income. So they, first wave, a lot of that money. Where did they get the money from? They had to borrow it. The central bank then came in and lent them. That was the primary. Then the second, when President Biden was elected, there was a second wave of that after COVID, It was mostly like a universal basic income thing. In other words, hand people money and we're going to be better off. And so they handed people money, doing that same exercise again. And so naturally, all these people got a lot of money. And so they deposited them in banks, they went out and spent, and so on. And it therefore shouldn't be surprising that we had a big wave of inflation. And we also had a lot of banks buy government bonds, which they lost a lot of money on. And that was that crisis. So that's how the mechanics work. You can't get richer by making money. And there are two purposes of money, which is as a medium of exchange and a storehold of wealth. Saving is very important. And if you don't have savers who have it as an effective storehold of wealth, then you don't have a viable long-term credit market. People don't understand that the bonds become a bad deal. You need that, like any marketplace, you need purchasers and sellers to be able to have an efficient negotiation to achieve a balance without the government coming in and printing a lot of money and make a big mess. It's like they made very severe negative real rates. And we know what happened with the severe negative real rates. And the government, while they were making the significant real rates, it was the government that was the big buyer. Okay, yes. So the government takes it on and they make negative rates. So what happens is then you get everybody leveraging up. Then you've got a problem. And it's a global issue. It's not just an American issue. First, when there's a lot of borrowing to service debt, there's what's called death spiral. We typically refer to that when a company has it, the government can have it too. And that is that dynamic where there's too much debt and you have to borrow to service the debt. People, investors know that that's a problem to service the debt, so the credit is worse. And that means that interest rates go up, which is the worst thing that can happen to a heavily indebted entity. And then as they rise, you get that spiral, you need to borrow more, and so on. So that is also noticed when then there is, the key spot is when the debt service becomes large. And then like the real red flag, the biggest red flag, is when there's then the selling of the debt beyond the new supply, but the holders of it sell it. And then you can see it in the market action because you can see that long-term interest rates rise while short-term interest rates aren't rising or go down. So it's the free market losing its desire. You have a balance problem in the free market out there. And then you start to see that when the currency then depreciates, particularly relative to gold or Bitcoin or other assets, and sometimes other currencies. But typically, these things happen, broadly speaking, together, in which all currencies go down relative to other things like gold, Bitcoin, or tangible values. And so that's what it looks like. That's that edge. Then you start to see the dynamic. So you either see the central bank comes in very quickly and does the buying, and when that happens, you see then the currency. To take Japan, for example, if you were a holder of Japanese bonds, you lost about 80% of your money relative to gold and about 60% relative to U.S. bonds because you received an interest rate that was 3% less than the corresponding interest rate in the United States. So you lost the interest rate. And interest rates in the United States, as you know, were very low relative to inflation for most of that time. Plus, you had a depreciation in the currency. So you lost a ton of money in the debt that way because the central bank came in and printed the money. It's very bad for holders of the debt. Right. And it's a basic thing. You don't have to even get too technical. It's just a supply-demand thing, While gold has gone up and Bitcoin has gone up. So that is that kind of market action I'm talking about. And you've seen it in other countries too. The UK, very classic. The dollar has been a relatively strong currency, but not measured in gold or Bitcoin. So all currencies have gone down, and then you've had that dynamic you're talking about. And you see it also in, like sterling is a good example. Sterling has gone down while UK bond rates have gone up and central banks have held it steady. And so you see it in the market action. You also see it in terms of who the buyers are. You've seen central banks, for example, and sovereign wealth funds shift to have lesser amounts of debt, bonds, and so on, at the same time as they've accumulated gold or hard values. Gold is the third largest reserve currency, by the way. Dollars, euros, gold, and then yen. So, yeah, you're seeing that supply-demand shift. And it's partially for all the reasons we're talking about, and also partially because of issues like geopolitical issues. Countries sometimes worry about sanctions. China is worried about holding bonds. You would, U.S. bonds. Japanese bought a lot of bonds. Even as a percentage of portfolios, the bonds themselves have become such a large, U.S. Treasury bonds and U.S. debt has become such a large part of the portfolio that it's even from a portfolio rebalancing point of view, you don't want so much concentration. All of those factors are in play for the supply, demand, and bonds. That's why I emphasize you have to look at the supply and demand of bonds. The United States and countries like China, you see that particular dynamic. China, Japan, they're all educational, and that means that the bonds, the debt, are bad assets. So then where you store it is in those assets that benefit rather than suffer from the reduced value of money and the buying of it. And obviously, you look at money and what is an international money. That is why gold is in it. And then there's a question of, Bitcoin or others are a conversation. We can digress into that. But it can be, ideally, it's international, it's mobile. Ideally, it's relatively private, so it's relatively secure, because in history, there's the value part of it, and then there's the confiscation part of it too, in some fashion or another. That confiscation can easily take the form of taxing on holding it.
Right.
For example, one of the problems with real estate, besides the fact that it doesn't move, so it's not internationally, you can't use it internationally, is it is a readily taxable asset. It's there. And therefore they won't take it and you can get it. So we have to understand that taxes and confiscations are one and the same. It's so interesting. I studied history, and of course I've been through a bunch of these, like the 70s. Commodities, ideally also those that might do well if the economy doesn't do well, because you're dealing also with the inflation environment, are always gone to. You don't want economically sensitive commodities as much, unless sometimes maybe the economy will do pretty well, but usually it doesn't. Like in the Weimar Republic, give an example, rocks were used as storeholder wealth. Now, that sounds really funny, but they were considered building ingredients. In other words, the rocks were used to build things with, and so they would store the money in rocks. But any asset, it is those things that can't be devalued.